Hi guys, today we are going to learn about the trial balance. We're going to do that by going through a question. But before starting, we need to know what the trial balance is. So the trial balance is something like this, which lists out balances, all the balances that were recorded at the end of the period. So it's really easy if you know the basic accounting concepts, what assets are, what liabilities are, and what capital is. So let's begin. First one, capital. Now capital is the owner's contribution. And so let's go into the basics first. Assets equal capital plus liabilities is the basic accounting equation. And in the previous video, I said that an increase in assets is a debit, an increase in capital or liabilities will be a credit. It's the exact opposite in case of a decrease. Credit, debit. Now that's in case of an increase or a decrease. Now these are balances. In case of balances, just look at this only. Right? Assets generally have a debit balance. Capital and liabilities have a credit balance. Simple as that. So, first question, capital 2500, that is a credit. So, we can go into our trial balance and say capital 2500. Next one, motor vehicle 720. Motor vehicle is an asset. So we say motor vehicle 720 in the debit side. Next one, building. Building of 3000. Building again is an asset. So that's in the debit side. $3,000. Bank loan. Bank loan is a liability because one day we will have to repay the loan to the bank. So the business is an obligation, which is then a credit. Bank loan 1800. Then we have cash. Cash 40. Cash is an asset. So it's debit. Bank overdraft. Bank overdraft is when you have a negative bank balance, basically. That means you have overdrawn money from your bank account, which means you will have to pay that particular negative amount back to the bank, which makes it a liability again. Bank overdraft, it's a credit of 90. Drawings. Now, drawings, I've told you before that it's the opposite of capital. That means when the owner takes back money or inventory from the business. So that is then a decrease in capital. So we have capital here. A decrease in capital is debit. And another easy way to remember this is look at the first two letters of the word drawings. DR, it's debit. Just remember it like that. That's easier. So 30. Drawings 30 debit. Inventory, those are the stocks that are held in the business for resale, which is an asset, it's a resource for the organization, which will lead to future economic benefits. So 500 is debit. Inventory 500. Another name for trade payables is creditors. Creditors. That means we bought goods on credit. When we buy goods on credit, we don't pay the suppliers right at the moment. We will pay later. So there is an obligation, which means it's a liability. So it's credited. Trade payables 350. Finally, we have trade receivables, another name, debtors. Opposite of creditors, in this case, we sell goods on credit, so the customer won't pay as and when we give the goods. The customer will pay later. So in the future, we will get money, which means it's an asset. 450. Trade receivables 450. So here we have the trial balance. We can now total them up and see whether debit side tallies with the credit side. So the debit side balances add up to 4,740 and the same with credit side, which means we have done it right.